Hi, good morning, everyone. Welcome back to the channel. So in this video, we're going to discuss a recent Bloomberg article that was published. And what I want to say before we begin, the article does a very great job of contrasting the risks versus rewards when it comes to high yield strategies, and goes into some incredible graphs that shows basically the gist of what I've been saying all along, of how when you buy the underlying, you have a much better total return over the long term than you do with these high yield strategies. So we're going to go into that real quick. But I will say, when I was being interviewed for my part of this article, I honestly didn't think they were going to go negative when it came to dividend strategies. Otherwise, I could have given them a lot more content. But I could say I've had my first experience of, like, I guess you could say, journalism, where they're doing an article, they're nice to you and all that, and they're just saying, hey, keep talking, and they're writing stuff down, and then you see what they actually use in the article, and it's a bit, shall we say, different. But anyway, let's discuss it. So this is going to be in one of my tabs over here. Let me make sure that let's see, where are we? Here we go. It's actually, I've got it up twice. Okay, let's try this one. Here we go. There's one behind a paywall, one that's not. Okay, so here's what we are going to cover. This is the article I've been hinting at for some time. And it's funny because my piece wasn't too big, but they used a lot of my pictures, so they must like me, I guess. All right, so what we're going to do, so this article was covering, it's on Bloomberg, it's covering our New York, basically. The title of the article is called "The New American Hustle: Dividends Over Day Jobs." And in my unfiltered opinion, it kind of makes us look somewhat stupid, like we don't know what we're doing. And if I would have known that was the angle they were going to go at, I could have given them a lot more. I could have shown them a lot more of my portfolio, saying, hey, look, I totally get the risk of these dividends. In fact, my exposure to specific dividend funds is actually very low. But anyway, let's read it. Okay, so that's the title of it. That's the picture of Rod there. It's funny because they called him the Godfather. So it says, decades of schooling, a lifetime at work, a couple of years to enjoy. If you're lucky, then it's all over. That's the deal generations of Americans have been sold for more than a century. Work hard and invest cautiously, and maybe you'll get a few good years to breathe. To a rapidly growing crowd of young retail investors, it's a ripoff. On a Friday afternoon in July, some 24 of them gathered in Midtown Manhattan to preach an alternate path, one paved not with paychecks, but payouts. Their mantra: plow money into a host of newfangled dividend-chasing strategies and use the steady stream of cash they generate to escape the 9 to 5. Never mind the long-term damage it might do to their portfolios. When I saw that, I said, ooh, this article is going to take a turn. There's me next to the lady that's in pink and green. She goes by Miss Roundhill. She has a channel also. What she called Bad Financial Decisions, I think. So in this picture here, you see Jay. I don't remember who the gentleman to his left or his right was. If you're looking my way, this guy here is Marcos. Marcos Milla. He runs a YouTube channel. And then the guy next to me, I don't know who he was, but this is kind of a goofy picture. I have like a goofy, that you can see they picked. I think they kind of picked a picture to fit a narrative, if you ask me. But anyway, so there's all of us. And then, so I'm not going to read the whole thing, but it goes into the guy that runs Dividendology. And he talks about, his, how he withdrew 40,000 to contribute to his down payment to his house. He has 217,000 subscribers on his Dividendology channel. He talks about how his grandfather worked at a factory his whole life, and he said he didn't want to lock away capital until he was 65. And then they said dividends, and believe it or not, I learned a new word in this article. Dividends, once the stodgiest corner of investing, which means boring or bland, basically. They've become the new hot thing with jaded Gen Zers, hell-bent on quitting and retiring early. But the new playbook isn't just about reliable payers like Coca-Cola, ExxonMobil. Today's dividend crowd is piling into ETFs offering eye-popping yields generated by complex derivatives. The broad category of income-generating ETFs captured $1 in $6 sent to equity ETFs as a whole in 2025. And that, folks, is a lot. I mean, let me see how this looks. I guess this looks okay. There's a lot of like white space. Smash that like button, by the way, if you so desire, if you're liking what I'm laying out here. So, all right, I want to enlarge the screen because we've got a lot of white space here. Here we go. Okay, let's see. Let me see. Okay, that's a little bit better, I guess. All right. So they called the philosophy one of the many quasi-religious. I haven't read a good article in a while. And, there's a side to me that's also a writer. I'm actually a very good writer. Believe it or not, on my SAT, I got almost a perfect score when it comes to writing. I think I only missed like one question. Unfortunately, we live in a society that doesn't give a shit about writing and grammar. They just care about numbers and math. So I've known people that like can't even hardly like write, but they're good at math. So that's kind of like what society pushes. Um, let's see, that's something I used to say back in college. So the most aggressive ones, dangling yields above 8%, have quadrupled in size in just 3 years. So it's a rapidly growing space for sure. The craze has sparked a network of YouTube channels and Discord servers, as well as the r/dividends forum on Reddit, which has grown more than tenfold over the last 5 years to 780,000 members today. So that gave me an idea. If I want to go fishing for followers, that's a fertile ground to do so. The philosophy, like I said, one of many quasi-religious, sprung up among young, financially insecure Americans worried about inflation, unattainable housing, and the prospect of AI-fueled economic disruption. Now, I would say I don't quite fit that bill because I'm highly financially secure. I'm young, and my finances are like, I call it the fortress balance sheet. Like I'm in impeccable order. Like I've done very well for my age. Um, like Trump would say, no one has done it better than I. I'm not going to go that far, but I've done decently. Unlike meme stocks or crypto moonshots, this strategy, what might be referred to as dividend and chill, preaches control and consistency, monthly drip over flash in the pan riches. Not YOLO, just yield. I kind of like that. Not YOLO, just yield. The current wave of interest is new enough, many of the followers young enough that it's been easy to ignore how the most popular funds have often lagged basic stock indexes. Now, that's interesting, folks. What do you all hear me preach all the time on this channel? I highlighted it in black here, but I preach this literally all the time, how these funds lag behind their underlying. I say that literally in every video. So, and they didn't quote me on that because I guess it didn't fit the narrative of the article. Let's see. This is interesting here. Samuel Hartzmark, a professor of finance at Boston College, has researched the issue for more than a decade and has found that investors tend to fall for the free dividends fallacy. And I literally gave them a quote that they didn't use in the article, which I'm kind of disappointed about. They said, "Why do you think dividends are so appealing?" And I said, "It's psychology. It's the illusion of guaranteed income." They didn't use my quote. I'll show you. So my piece ended up being shorter than I thought it was going to be, even though they had a whole photo session and all that. Which is funny because I was actually accused of this article not even existing. So, the next step will progress from, okay, it didn't, not only did it like not exist, but, oh, your piece was short. So see how we're progressing. We're making progress, incremental progress, but progress nonetheless. So a lot of people think dividends is separate from the cash flow. And this is a key distinction. See, people are commingling the YieldMax dividends with the cash flow and the balance of their portfolio, which is actually declining. So it's like a lot of people said early on, including me, it's like they're just giving you your money back. Now, all I do at this point, I report on the dividends. I say, look, the income's good. Even Rod said that. The income's good. We all agree the income's good. But how is it for your long-term portfolio? Okay, so the professor called it the free dividends fallacy, treating them as capital gains as separate. A 2015 paper of his finds that investors prone to that bias have a preference for funds that report boosted dividends, even if they don't improve overall returns. A lot of people think the dividends as separate from cash flow. They don't realize it comes at the expense of price level and isn't making you richer. That's key. And I may not say that as bluntly as him, but when it comes at the expense of the price level and isn't making you richer. And that's a professor at, what do we say, Boston College? There we go. Professor of finance at Boston College. So somebody that researches this, that spent like probably decades researching this stuff, that I would say is somewhat qualified to talk about this, right? I would venture to say more qualified than a YouTuber. But what would I know? Because I supposedly went to an online school. Anyway, sorry, I keep sipping water here. Overtly philosophical discussion makes me thirsty. All right, so the appeal of regular payouts has long led investors into stocks and funds that offer quarterly and annual income. Christine Benz, no relation to Mercedes-Benz, of Morningstar, calls it the psychological pull of the bird in the hand. And this is almost exactly what I said that they didn't use, psychological pull. I said it was a psychology. Dividends are psychology, the illusion of income. One of the biggest dividend-focused ETFs, which is the Schwab, the one that everybody likes. I'm not as fond of it, but the SCHD, launched in 2011, 70 billion in assets under management with a yield of around 4%, which is very low. A new fast-growing generation of funds offer payouts that are much higher, sometimes above 100%. Take one product operating under the ticker symbol MSTY, one of our favorites that we just talked about, tied to the volatile stock of the Bitcoin hoarding company known as MicroStrategy. So this chart, this is really the bread and butter, the bulk of the article here. This chart was amazing. I've never seen a chart like this. So there's 4 parts to it. And this, to me, this illustrates it perfectly. Let's examine 3 ways of getting exposure to this company. So method number 1, and this is the value of 100,000 investment over time. The index of the graph goes all the way from 100,000 to 600,000. So strategy 1, invest directly into the stock. In a hypothetical scenario, one investor buys 100,000 worth of the stock of the Bitcoin holding company Strategy in 2024. Since then, the rapid growth of the firm's shares means that the value of the investment is now more than $463,000. That's almost a 5x. That's good classic growth strategy. So that's like basically in 1 year, which means long-term capital gain. So that's a great way to grow your money. And guess what? When you sell that, you just got, when you talk about high yield, you just got $363,000. And as we know, Warren Buffett is not a fan of dividends because he says when they pay dividends to you, it means they basically have no better way to allocate that money. So he thinks it's dumb. Strategy 2, you see how this drops. So this dropped by 120,000. Invest in the dividend-focused ETF MSTY that provides exposure to the same company, reinvesting the dividends. Another person places their money in a dividend-focused fund, MSTY, that offers exposure to the same company. Even if the person reinvests all the dividends paid out, the investment will be worth about $343,000, or roughly $120,069 less than if they had bought the stock directly. So you see how it's going down as you're doing a dividend-focused strategy, but it gets better. Strategy number 3, invest in the dividend-focused ETF while withdrawing dividends. Now you're 192,000, almost 193,000 lower than your original just doing growth. This is perfect. Honestly, this is like the best video for growth this is like the best way to illustrate growth versus income that I've ever seen. They nailed it. So a third person uses MSTY's dividends as income, withdrawing the yield as it comes in. The dividend payouts they pocket plus the value of their ETF holdings are together only worth about $270,000 or almost $200,000 less at the end of the same period than if they had put the money directly in the strategy. So if anybody hasn't kind of been hit with that proverbial 2x4 yet, basically the gist of this article, they're kind of calling dividend investors stupid, if anybody hasn't picked up on that yet. And again, it doesn't mean I'm anti-dividend or anti-income. You know, I love everybody, but you gotta, as an investor, you know, I coach people to seek the highest total return possible. Okay, so that's that, but it gets better. So watch this. Now, watch this. Now you're down, but if the dividends, so since the dividends are the bulk of MSTY's returns, after this investor uses the dividend checks to fund day-to-day expenses, all that's left is the value of the ETF. This is where it's absolutely devastating to your portfolio. If you just take the money and run, basically, you know, like they say, set it and forget it, and you're using it to go on vacations, you're using it to go on cruises, you know, trips to the Bahamas, trips to Europe, Asia, wherever, trips to go pick up a wife in the Philippines. You know, that could be a business expense, but you get the gist. So now you're only left with 73,000 out of your original investment. So you've lost 27,000, but I get it. You've gotten the dividends, you've gotten the income, which is all some people care about. You see the big profound difference here between having, and I've tried to illustrate this in my videos, which is a shame that they didn't talk more about that. But you can see the big difference. 463,000 at the top, 73,000 at the bottom, where your ETF portfolio has actually lost money. So the fund has roughly $5 billion in assets and promotes a distribution rate. I like how they put distribution rate in quotation marks. Now, I'm not going to read the whole article here. Who's this Igor Butnaru? We got Igor on. I assume Frankenstein lags shortly behind. What are your thoughts on COYY? Well, that's very coy of you to ask that question, but that's not going to be the focus of this video right now. We're going to be more focused on this article, but I'll look at that later. It's not a dodge. It's just, now maybe if you super chat me, maybe, just maybe I'll strongly consider looking at it about that. All right. So distribution rate in quotation marks. Got to love that, right? Okay. So I'm not going to read all this, but you get the gist of that. So interestingly, and I learned this too, changes made since 2019 by the Securities and Exchange Commission streamlining ETF approvals and derivatives rules cleared the way for the wave of funds and new asset managers offering massive yields. So, and here's a picture. Look at that. They liked me. They put me in several pictures. And here's Miss Roundhill again. Here's my new mic that debuted on that trip. And I was talking to her, interviewing her. Basically, there's some content that I still haven't published from that trip. But anyway, so you see that was our reception that we had in New York. It says financial influencers focus on high yield ETFs gathered in New York at an event hosted by YieldMax. Interestingly, they took probably hundreds of pictures, but you're only seeing a handful of them. So I'm kind of impressed that I made half of them. So the math these products use, payouts today, erosion tomorrow, have drawn sharp criticism from Wall Street pros who warn that investors may mistake current trends for long-term wealth, ignoring how big yields often come at the expense of price returns and overall portfolio growth. That's key. Ben Eifert, managing partner at the volatility-focused hedge fund QVR Advisors, has been an outspoken critic of some of the issuers behind this new trend. They're fooling people into thinking they're somehow getting income. All you're doing is giving me my money back. Now that's profound. So the value of the ETF is declining as you're paying me that. YieldMax executives, for their part, say they are upfront about what their products are designed to do, generate attractive yields for their holders. And they're not lying. That's what they're doing. Okay, so let's look at some more charts here. Look at this, the Spider S&P versus JEPI. So they didn't just pick on YieldMax, they picked JEPI also. See that $57,000 less total return? How about this one? This one's profound. Coinbase versus Coney, 159,000 difference in total return. How about this Moderna versus MRNY? That's only a $2,000 difference because it's all downside basically because they capture all the downside. 14,000 difference between C3AI versus AIYY, which is another crappy stock. Okay, now let's go down because they save the best for last. Was my part because you're probably wondering, wait a minute, wasn't this article about you? Well, I am in here. So look at there I am again, and that's it's funny because this was me. If you go back to my video last Friday, I was in the middle of live streaming this video while the photographer was there. So he took this picture at my pool while I'm on my channel live streaming. So there's that. Dividend stocks have always come with additional tax liabilities because, and that's another thing to consider, tax liabilities, because each quarterly or annual payment is considered a taxable event. Exactly. But then you have the return on thing too. And then there's a big section about Rod from Retire on Dividends. For some reason, of all the YouTubers that they took, for some reason, they wanted to use my analytics. Like they picked some random bum like me to use my analytics. I don't understand. They could have used Rod's. They could have used Dividendology or anybody else. Let's see. So Mr. Igor must have his caps lock on. Please consider this is a new fund from Granite Shares, 180% yield. Oh, 180%. I got to drop everything and go look at it right now. Thank you. Yeah, I'll consider that too. But try to turn your caps lock off first, and then we can talk business. Okay, so there was my paltry metrics for the last month, which honestly, June and July were solid months for me. It's funny because I would say in like late May was when kind of my new wave of haters came about. And it's almost like they were helping to grow my channel in a way because it from May to June, July and all that. I took a step back in August because I also took a step back from uploading. But June and July, it was like the growth those were two of my best months as a YouTuber. So that's me. So this is my part here. So that's me. I was invited to the NASDAQ event by YieldMax. Says I watched my father, an electrician, work and save up for retirement without being able to enjoy the journey. I'm kind of disappointed about the quotes they took from me here because I gave them a lot, but they decided to pick this one. So I said, when you graduate college, you're like 22, you're young, you have the good looks and all that. I mean, I still do, obviously. Wouldn't we all agree? I mean, look at this face, you know, but you don't have the money. And so it's like, well, how do you get the money fast? See, that kind of makes me sound stupid, which sometimes I do that on my own. But anyway, so I quit my job at a Wall Street bank in 2022, took a position in a more flexible firm, allows me to work from home, grow my YouTube channel, live off dividends now. About 60% of my net worth is in income-focused strategies, including options plays he's put on leveraged ETFs. So they lumped all my options trading in with my entire, they called it income focused because I guess, you know, the options are generating income. From my portfolio, I generated about 65,000 in dividend payouts last year, which is totally true, totally verifiable. In fact, you wanted to fact check that. It's real easy, actually. Yeah, they created a narrative, right? Okay, so let's do a little bit of fact checking here. So I'll just show you all real quick. And I show this all the time, but basically the dividends from last year, this is what they're quoting. It's right here. So that's this year. This was last year, 64,308. So I rounded up 65,000. And I had a few more residual. If you add like interest and all that, you know, that's all 65,000 total between accounts. But bulk of what they were talking about is actually income focused strategies. My options trading, which before I started this video, I got an early start to the day because I got a full day ahead of me. But let me pull up my Google Sheets here. Here we go. Okay, so I put together, I'm starting to analyze my assignment risk on some of these because I'm going to end up probably getting assigned. But what I want to show you, this is what they were talking about that they considered an income-focused strategy. That was my options trade. So this is in my main IRA. This is everything I have open at the moment. So this basically, this is the premium. I'm getting 250,000 in premium just from this one account, which is mine regardless. I keep that money. But these aren't, these are options. So that's what they were. Let me make sure that's shared properly because I know how the screen likes to get black on me. So those are my income focused strategies there that are actually options trades. So anyway, folks, that's pretty much going to do it. If you like that, please remember to smash that like button. Do it now. You know, there's no moment like the present. Let me see. I got a comment from AC123. Different sectors in the market has ups and downs. This is one of the cons to invest in single stock ETFs. Yeah, I agree. Anyway, thank you all for tuning into this one. Please remember to like, comment, and subscribe, and join Discord. And we will see you all in the next one. Take care. Have a great day. Bye.